Accounting Enrichment Society, also known as AcES, is an interest organization of De La Salle University das Marinas under its accountancy departments. AcES, which is operated by BSA and BSM students, is here to assist their fellow students from the same accountancy and management accounting programs with their studies, mainly their accounting-related lessons. The students are given enrichment classes they could attend to, and extra lectures, tutorial sessions, and learning materials which may all help them understand accounting concepts easily. This academic year, AcES is stepping it up by creating YouTube tutorial videos about accounting concepts. Fun, interactive, enlightening, and broadening. AcES YouTube videos are surely not just another extra lecture and tutorial session, but also a fun and interactive way of learning.
Welcome to AcES Tutorial Video Sessions. This session is prepared by Imee Edino, Julia Carino, Zaynab Juralbar, Kenzel, and Casey Sevilla. Bago tayo tumungo sa accounting lesson, alamin muna natin kung ano nga ba ang AcES o Accounting Enrichment Society. Ang Accounting Enrichment Society ay isang organisasyon ng mga estudyante sa De La Salle University das Marinas na naglalayong turuan ang mga kapwa nila estudyante ng mga accounting lessons tulad ng Merchandise Accounting, Intermediate Accounting 1 at iba pa. Aside from N-class or enrichment class, you can also get lessons from us through our tutorial videos uploaded on our YouTube channel. We prepared a list of topics na gagawa namin ng tutorial videos and divided it into 3 batches. This video is included in the second batch of tutorial video sessions, which consist of topics such as merchandising business, manufacturing business, and value-added tax transactions. For this video, we will be discussing the merchandising business, so don't skip if you want to learn more about the topic. Now, let us proceed to our topic, merchandising business. You can get your paper and pen so you won't miss out the little details. But before we proceed, let's first have an overview of merchandising business. You must remember that in merchandising, it involves buying and selling of products as compared to a service business which, from the word itself, only provides services to its clients. For you to better understand merchandising, a great example would be the National Bookstore, wherein it buys a variety of books and school or office goods from different suppliers and puts it to the store to sell to different customers. Let's remember that the person who buys and sells merchandise is called a merchandiser, which can be a wholesaler or retailer. So, what is the difference between the two? A wholesaler buys a bulk of products from a manufacturer or another wholesaler, then sells the bulk to a retailer or another wholesaler, while the retailers buy merchandise from the manufacturer or wholesaler, then will sell it to the customers. Here are the other terms which you will encounter in this topic, so better to take note of all of this. First, in merchandising business, the seller must maintain a stock of goods held for sale to the customers in the normal course of business, called merchandise inventory. And once the goods are delivered to the customers, it is recognized in the income statement as cost of goods sold, or you can call it COGS. In short, it represents the cost of the merchandise that has been sold. And when it comes to the revenue, the merchandiser uses an account called sales revenue, unlike a service provider which mostly uses a service revenue account. In addition, in merchandising, since it involves buying and selling of goods, it is normal for a merchandiser to sell the goods at above its cost to be able to earn a profit. So the sales revenue, which is the amount of the total sales of goods less the COGS or the total cost of goods sold represents the gross profit or the markup set by the merchandiser. The income statement of merchandising business is complex compared to service business in a sense that the former contains more processes than the latter, and we will explain more about it in the next clip. So stay tuned.
Now let us go further towards accounting for merchandising. Sales revenue, as we all know, is the income generated from selling and or trading goods before any expenses are deducted. It increases the business assets and equity. It may be accounted for as either cash sales or credit sales. So the difference is that the former, which is the cash sales, is recorded when cash is received upon selling the goods, whereas the latter, the credit sales, is recorded when a receivable increases upon selling the goods. So what are the items that are included in our computation for sales? We have the gross sales, sales discount, sales return, and allowances for us to arrive at our net sales, which will be an important factor in computing for our gross profit and our net income. So, first is gross sales. So, this refers to the total sales representing the total revenue before any deductions. Second is sales discount, which is a contra revenue account to sales. It applies to credit sales, which reduces the invoice price to encourage the buyer to make early payments. Here we would consider the credit terms, which indicate when the payment is due, and the discount period. So to illustrate, for 15 and 30, which means that 40% discount will be given if the buyer paid within the 15th date from the date of sale. If the buyer had paid on the 18th or 16th date or so on from the date of sale, he is not eligible to receive the discount. So we will go over with this again in the next concept, which is the purchases. Third is sales return and allowances, which is also a contra revenue account to sales. It applies to all sales, credit, or cash. So sales return arises when the buyer returns defective or wrong goods to the seller. And sales allowances arises when the buyer agrees to keep the defective or wrong goods for free or at a price lower than the original price. So the journal entry for this would be debit, sales return and allowances, credit, cash, or accounts receivable.
For the buyer's perspective, we account this as purchases in merchandising business. So, what is a purchase? It is the cost of buying inventory during a period for the purpose of sale of the business. In merchandising business, it is therefore a kind of expense and is hence included in the income statement within the cost of goods sold. As purchase results in increase in the expense and decrease in the assets of the entity, expense must be debited while assets must be credited. A purchase may be made on cash or on credit. Freight-in is the transportation costs incurred in purchasing a product. It may be made with a term FOB shipping point or FOB destination. FOB shipping is the status wherein the buyer shoulders for the transportation cost, which would be capitalized to the purchased product. It is presented as an addition to the purchase account. So, when we talk about purchase discount, we are referring to the buying of goods and services by the business. Hence, the purchase discount is from the purchaser's perspective. When purchase of merchandise is made on account and the payment is done within the discount period, the buyer avails the purchase discount. Hence, payment is computed as the invoice price minus the purchase discount. A purchase discount is a discount that businesses offer to purchases as an incentive for early payment. Credit terms are the payment terms of purchase as stated on the invoice. Most credit terms express the discount time period, and the final due date. Example, 315 and N30. This means a 3% discount if paid within the 15th day. Otherwise, the full amount is due in 30 days. And now, let's discuss purchase returns and allowances. Just like purchase discount, this is a contra purchases account, meaning it is deducted from gross purchases to determine the cost of net purchases. Purchase returns exist when the sellers allow purchasers to return merchandise that is defective, damaged, or unsuitable. On the other hand, purchase allowances are the amount granted to purchasers as an incentive to keep goods that are not as ordered.
Now that all of the important concepts had been discussed, we'll be moving forward to the computations and their formulas. Here's the formula when accounting for merchandising. Actually, this is just the basic format. So we have sales less cost of goods sold equals gross profit less expenses to arrive at our net income. We also have the complex format, which is gross sales less sales discount and sales return and allowances to arrive at our net sales, which will then be deducted to our cost of goods sold. And our cost of goods sold can be computed with purchases plus freight in, and then deduct the sum to the purchase discount and purchase returns and allowances to arrive at net purchases. The net purchases will then be added to our beginning inventory that would equal to our merchandise available for sale to be deducted to the ending inventory to equal to gross profit. So the gross profit would then be deducted to our expenses to arrive at net income. It may be hard to understand at first, but once you have mastered the concepts, you will surely understand why some are needed to be added and why some are deducted.
To understand the concept, let us now go to our illustrative problem 1. Provided here are the beginning account balances and the transactions under merchandising. We will provide the corresponding journal entries for all transactions to apply our understanding based on the concepts we learned today about merchandising business. On January 1, sold merchandise on account to M. Ceniza Trading amounting to 800,000 pesos with terms 5/15 and over 30. In this case, we will debit accounts receivable amounting to 800,000 since we made a sale transaction on account and credit sales of 800,000. Take note that the cash discount is only deductible upon payment within the discount period only, not on the date of sale. On January 5, sold merchandise on account to V. Bacani 500,000 pesos with the term 2/10 and over 30. The entry here is to debit accounts receivable of 500,000 and credit sales of 500,000. On January 8, we bought merchandise on account from N. Napila amounting to 10,000 pesos with credit terms 3/10 and over 30. Paid 100 pesos for the freight. As you can see, there are two transactions here. First is the purchase transaction on account and second is the payment for freight cost. On the first transaction, The journal entry is to debit purchases worth 10,000 pesos and credit accounts payable of 10,000 pesos since the purchase is made on account. And for the second transaction, we need to look first on the shipping terms before we will make a journal entry. Since it is not stated in this transaction about shipping terms, we assume that we are the ones who are responsible for freight cost. With this, we will debit freight in amounting to 100 pesos and credit cash of 100 pesos. On January 9, paid rental for the month of 15,000 pesos. The entry here is simply debit rent expense of 15,000 pesos and credit cash of 15,000 pesos. On January 10, paid half of the notes payable. As you see in the opening balances of accounts, we have a note payable worth 400,000 pesos. In this transaction, it states that we paid half of it. So we need to divide the total amount of note payable, which is 400,000 pesos, by 2. And we arrived at 200,000 pesos. The entry for this transaction is to debit notes payable at 200,000 pesos and credit to cash at 200,000 pesos. On January 15, collected the account of January 5 transaction. As you recall, in our transaction in January 5, we sold merchandise on account to V. Bacani amounting to 500,000 pesos with the credit terms 2/10 and 30. In this transaction, our customer paid this account in full. As you see in credit terms 2/10 and 30, he was able to pay it within the discount period. Hence, his payment is subject to cash discount of 2%. To compute the amount to be received, we need to multiply the list price, which is 500,000 pesos, to 98%, which represents the net percentage of cash discount availed by the customer. It is computed by simply deducting 100% to 2% cash discount. With this, our journal entry will be debit to cash for the net amount we received, which is 490,000 pesos. Another debit to sales discount amounting to 10,000 pesos and credit to accounts receivable for 500,000 pesos. For January 17, collected the account of January 1 transaction. As you recall, in our transaction in January 1, we sold merchandise on account to M. Ceniza Trading amounting to 800,000 pesos with the credit terms 5/15 and 30. Unlike in January 15 transaction, this is not subject to cash discount since the customer paid beyond the discount period. The journal entry for this transaction would be simply debit to cash and credit to accounts receivable of 800,000 pesos. For January 18, pay the account of January 8 transaction. Remember that on January 8, we bought merchandise on account from N. Napila amounting to 10,000 pesos with credit terms 3/10 and 30. In this transaction, we are now paying our liability to our supplier. And since we paid our account balance within the discount period, we will deduct 3% from our list price to arrive at the net amount to be paid to our supplier. Hence, our net amount to be paid would be 10,000 pesos times 97% equals 9,700 pesos. And to compute the purchase discount, we will multiply 10,000 pesos by 3%, which will be equal to 300 pesos. Our journal entry for this transaction would be debit to accounts payable of 10,000 pesos, credit to cash of 9,700 pesos, and credit to purchase discount of 300 pesos. On January 21, sold merchandise for cash amounting to 150,000 pesos to ACE Company subject to 10% trade discount. Paid 2,000 pesos for the freight. In this transaction, you will notice that the merchandise sold is subject to 10% trade discount. A trade discount is referred to as the discount that is offered by a seller to the buyer of the product in the form of reduction in the price of the item. Trade discounts are offered to increase the sales of the product and make the customers feel that they are getting the best offer. Please take note that trade discount is not recorded in the books of the buyer and seller. The list price will be deducted to trade discount to arrive at the invoice price of the goods. So in this transaction, we will compute first the invoice price by multiplying the list price of 150,000 pesos to net percentage of trade discount, which is 90%, to arrive at the invoice price of 135,000 pesos. Our journal entry for the sale transaction will be debit to cash at net of trade discount of 135,000 pesos and credit to cash of 135,000 pesos. And for the payment of freight cost, we will debit freight out of 2,000 pesos since we are the seller in this case and credit cash of 2,000 pesos. On January 23, Edison withdrew 70,000 cash from her business for personal use. In this transaction, we will simply debit Edison drawing of 70,000 pesos and credit cash of 70,000 pesos. On January 24, received returns from ACE Company because of poor quality merchandise of 18,000 pesos. The journal entry will be debit to sales returns and allowances of the amount returned, which is 18,000 pesos, and credit to cash of 18,000 pesos since the sale transaction to ACE Company last January 21 is on cash basis. On January 25, purchased merchandise from hang on account amounting to 19,000 pesos with credit terms 2 over 20 and over 30. Paid freight cost of 1,000 pesos. Our journal entry here is to debit purchases of 19,000 pesos and credit accounts payable of 19,000 pesos. And for the payment of freight cost, we will debit freight in of 1,000 pesos and credit to cash of 1,000 pesos. On January 26, return to hang merchandise with a selling price of 2,500 due to bad order. The journal entry for this transaction is to debit accounts payable worth 2,500 pesos since as you recall on January 25 transaction, we purchased merchandise from hang on account and credit to purchase returns and allowances of 2,500 for the merchandise returned. On January 28 transaction, Edison invested additional 50,000 pesos cash to be utilized in the normal operations of the business. The journal entry for this transaction is to debit cash at the amount the owner had invested, which is 50,000 pesos, and credit to Edison capital of 50,000 pesos. On January 30, paid salaries to store employees amounting to 150,000 pesos. The journal entry for this transaction is to simply debit salaries expense at the amount we paid to salaries of store employees, which is 150,000 pesos, and credit to cash of 150,000 pesos. On January 31, actual inventory through physical count amounts to 45,400. In merchandising, take note that we will always make inventory count at the end of each accounting period to determine the ending balance of inventory. To record this transaction, we will set up an ending inventory balance account. Hence, the journal entry for this is to debit merchandise inventory and at the amount of the ending inventory balance of 45,400 and credit income and expense summary account of 45,400.
Now that we are done discussing the inventories for merchandising, stay tuned for the next one because another batch of tutors will discuss the inventories for manufacturing. Don't forget to like, share, and subscribe to our YouTube channel for more accounting related topics. See you on our next one.